Hello everyone, how's it going? In today's video, we're going to talk about Clover Health, trading under the ticker symbol CLOV. So this stock has been another one that has been very popular with retail traders for some quite obvious reasons. It is a stock that offers potentials for disruption within an industry that does need some dust off. And it is also a stock that has benefited from the stock craze from 2020 to 2022. Of course, the reality check was also very brutal and sometimes unfair. Not completely uncalled for either. I mean, if you look at its website, if you look at what they do, the services and the products that they offer, it is very hopeful, right? It is something that a lot of people are looking for, so lowering insurance costs and also lowering medical expenses overall. And they do have a certain global presence, so all these elements make Clover a very good stock to put your money on, at least back in 2020 and 2021. Now, given that we are well into 2022 and soon in 2023, it's fair to say that things have not played exactly the way we wished they have. We can say with the benefit of hindsight that, yeah, okay, we were warned that this bullish run is not going to run forever, but it's very easy to say now that it has fully stopped, right? Back in 2021 and 2020, it's very difficult to predict how things are going to go. We just know that a massive amount of money went from different parts of the financial markets into the speculative and riskier side of the growth and startup stocks. And this is why a lot of those companies went up back then. I have said in my earliest videos, and it's probably not for Clover, it's for the EV companies, that one day the music is going to stop and that the capital will flow back to other sections of the market. Of course, I thought back then that they're going to flow back to like other stocks, but it seems like they're actually just flowing back to even safer options, like fixed income assets, bonds, and so on. Anyway, so this is just a small tangent for where the capital came from and where they've decided to go. It is interesting to also note that Clover may be a company that'll disrupt and rattle the cage of a massive industry, the industry of insurance and maybe even reassurance. So everyone who makes money off probabilities. This is a massive industry, and trying to reduce, basically undercut the competition may be a toilsome journey, to say the least. Are they going to meet resistance from the rest of the industry? I don't think that it's gonna come from this. Like, I don't think that other bigger players are going to try to squeeze Clover out. If they do, that'll be pretty clumsy. I think that what's going to happen is that in time, they will have to respond to almost like the gravitational strength of this industry, in the sense that there are a lot of positions in the medical field that are very well paid, right? Well, that money has to come from somewhere, and that somewhere, especially in the United States, is from the patients. The other major portion would be the private insurance coverage. If they have the potential to bring those expenses, these costs down, then all the power to them. This is why I myself have some, I do hope that this company will do well in the future. I just don't think that they can bend the law of physics like this. So recently there was a stock analysis on Reddit. They have, listed quite a few points, which kind of justify their bullish position. So I want to go point by point and maybe share my view on those topics. So I don't necessarily disagree with every single point of, what they've said. That's not my objective, obviously. But sometimes I think that we do have to take a step back and to look at what do those sections tell us or suggest in the absolute sense. So the first point is inflation. The post has said that, with money supply that's expected to become tighter, this may have a positive effect for Clover in the sense that because there's less money circulating around, maybe the cost for like medical products and medical services will also drop down. Is this going to necessarily be true? I do have some doubts over this. I mean, maybe I didn't read it right, but if I understand correctly, what they're saying is, given that there is a quantitative tightening at the moment, it'll be a matter of time before the costs come down, which will play in favor of Clover. So there is a quantitative tightening, but there is also inflation going. In fact, the QT, the quantitative tightening, is a reaction of the inflation, almost hyperinflation in some regions. Like, for example, in the supermarkets where I live, things sometimes have doubled over the course of weeks. And I'm talking about like basic daily life products like toilet paper and that kind of stuff. So I would say that before they shrink, we're going to see the prices probably go up still from where they are. Because this time the inflation is not caused by the amount of money circulating. It's more caused by the rarefication of some basic resources that has pushed the rest of the costs up. So in the long term, I think that, and of course, if you don't enter in now, like if you wait for a few months or even a few years, yeah, the tightening will have its effect and the inflation would be reined in. If we compare the prices back to 2020, 2021, and you expect, the tightening to go lower than the price level of those years, I think that's a bit pushing the logic to the extreme. So I don't think that this will happen. But yes, the fact that interest rates are going up will eventually have some benefit for the business of Clover. Now, speaking of inflation, usually when inflation happens, this basically means that money becomes more expensive, right? The cost of having money is more expensive. And when that happens, usually people, at least more people, are inclined to put their money into banks and to buy bonds and to buy like savings accounts instead of buying stocks. So the inflation is a bit of a double-edged sword. It's maybe good for the business of Clover, but for its share price, I'm afraid that that's a bit of another story. Now, the second point seems to be centered around the idea of supply chains. Clover doesn't really buy products from overseas suppliers, so if anything happens with the supply chains, they're not going to be affected by it. Yeah, that is true. Now, we also have to remember that even if Clover doesn't buy other products itself directly from overseas, it's hard to say how the dominoes are going to fall and how far are they going to fall. So what I'm saying is, because the medical stuff, they can go up or down in prices in bulk, and they can go up in prices together. It's not because a few products are not affected by the supply chain issues that the whole cost, the overall cost, is not going to be affected by it. Because if Clover offers insurance type services and medical and Medicare plans, they will have to cover the cost of all kinds of products. So it's not just because the things that they buy themselves are not from overseas that they will not be negatively affected by it, if you understand what I'm saying. Because of its business model, it's going to have to be exposed to those supply chain issues. By the way, those supply chain issues, I think that even if they may be a bit of a headache in the short term, in the long term, they're likely going to go back to where things were. However, we also have to remember that whatever happens to the supply chains, it affects many different sectors, and they're probably already baked into people's expectations. So what you currently see is kind of like the expectation of how well things are going to go on our way going forward. Sometimes we say that the stock market reflects the current and the past. This is certainly true. I think that it also reflects our perception of the future currently, if it makes sense. Like it is basically the current value of the future potentials in some ways. So the next point that they've mentioned is regulatory. Now, the current emphasis of the governing bodies and the regulators is to bring down the medical cost and to favor, awareness of, and to make sure that people have the services that they need. This is certainly true, and this is something that the federal government has been clear about, and they've even elected laws to counter this issue. With that being said, for the moment, those are good intentions. They sound decent, but we also have to consider whether the federal government in the US has in by itself the power to counter major trends within sectors. Prices don't just go up or down by themselves. They go up or down because of some macroeconomic phenomenons. Can a law, can a consensus like this, can a decision influence the future outcome of entire industries? You see what I mean? I can see where this can be effective in the sense that they can bring in some federal subsidies, and this will have an immediate effect on the price. So for example, when the oil price went up, for the obvious reasons, right? When oil price went up, strategic oil reserves have been released in different countries, and as a result, it brought the price down. Now, this certainly works in the short term, but does it necessarily work in the long term? This is where I tend to have my doubts. Subsidies can run for a time. It's a bit like the AmWorks in House of Cards Season 4. I don't know if you've watched it. Basically, the president wishes to lift up the unemployment rate by giving federal subsidies. Yeah, it's going to work for a time, as long as the money is in. Now, if the money cannot flow in forever, then this is going to be a short-term band-aid solution. So overall, is this measure going to affect positively Clover? I think that it will, at least in terms of the narrative. Whether people really will have, inexpensive medical care, that is a whole other discussion. Because we have to remember that in the stock market, the narrative and the speculation on the narrative and the speculation on the speculations of the narratives is something that may matter a lot more than the reality, unfortunately. But we are in this arena, so we do kind of have to play by the current rules. The final point that I want to raise is a potential for merger and acquisition by a bigger company. This is possible. First of all, like I said before, Clover is in a massive industry with other companies that may be disrupted by its business model. So when other companies have a lot of cash, or they see that Clover is lower on the market cap evaluation, then an M&A could occur, and then they usually buy above the current market price for the shares. I would say that if it happens, it can be something good for shareholders who bought it when it's low. Certainly not when it was at its height back in 2020 and 2021. Now, we are currently in a quantitative tightening context, so companies may be more likely to look after their own, money pouches and not necessarily spend huge amounts of money around. With that being said, it's possible that somewhere in the future, Clover will become an interesting target for other companies if it remains in a low price point. And that would also assume that the acquiring company has a very sensitive PR side. So they want to make things interesting. They want to, buy a company that resonates with retail investors. And they also want to kind of sort of take at least the image, if not the substance, of Clover. So this would be the kind of company that, in my opinion, would be interested into buying Clover. So the last point, I think, offers some additional incentive to buy in Clover at the moment, which kind of gets to my conclusion. Should you buy Clover at the moment? In my opinion, yes. The stock price has been very low compared to where it was, and there is little to no indication suggesting that it's going to keep falling like this. Like, we're not going to see some fall over the cliffs just because the market wants to play with the retail investors. Clover follows the overall market trends for growth type companies. And right now, this industry has fallen enough in the eyes of the market to keep falling. So this is why I think that if you buy in now, the upside is going to be larger than the downside. The last point here, the M&A, is something to consider within the next few years. It's possible that they can be absorbed by someone bigger, and in that case, you can realize a pretty hefty profit from this merger if you buy it at a relatively low price point, which in my opinion is now. So my exposure, like the maximum exposure that I would recommend, would be around, I would say 3% of your portfolio, if your positions are diversified enough. If not, then I would say maybe stay around 1 or 2%. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.